Stretch your retirement savings. One of people's biggest fears in retirement is running out of money, which can be a double-edged sword because they also want to live for today and enjoy what they've built up their entire working careers. So beyond some of the obvious answers with spending less money, working longer, retiring a little later, we're going to explore some strategies today that may help you stretch your retirement savings to last just a little bit longer. That all starts with creating a withdrawal strategy on how you're going to manage the distribution of your assets. This is going to be paramount, making sure you don't run out of money before you expire. Above all, this manages sequence of returns risk, which is the concept where when the stock market falls and you start taking money from the portfolio, your balance may never fully rebound, even if the stock market does. In other words, you want to avoid having to withdraw money from your accounts when the market is down. Okay, so let's talk some strategy. One of the biggest ones and most well-known is the 4% rule. This is the most popular, mostly because it's tried and true. Essentially, every year, look at the overall balance of your retirement assets. You multiply that by 4%, and that would effectively give you a number that you can withdraw safely. So let's say you have $500,000. 4% of that is going to be $20,000. That would effectively be the amount of money you could pull from the portfolio and not be terribly concerned about running out of money, assuming you're growing the assets at around 6%. You could look at a dynamic withdrawal strategy. So with a dynamic withdrawal strategy, that helps you respond more appropriately to changing market environments and your changing needs. So let's say in 1 year your investment mix goes up double digits, like 10, 12%. Perhaps that year is a year in which you can spend a little bit more than just the 4% as the previous strategy suggested. But you also have to take into consideration markets don't only go up. Sometimes they go down, so you may need to adjust your spending downward to align with what the market environment is providing you. We can also look at an income floor strategy or a flooring strategy, which helps you control how long the money will last by making sure you don't have to sell stocks when the market is down. That way you always know your basic expenses are covered even when the markets go down. So you can use your invested savings for discretionary expenses. So it works like this. You figure out the total dollar amount for your essential expenses, housing, food, keeping the lights on, Netflix, and that is guaranteed from other income sources such as Social Security, bond ladders, dividends, CD interest, etc. So let's talk taxes. Taxes is a huge way to save money. Understanding the tax implications of where you are creating the retirement income will have a long-lasting effect on your wealth and its sustainability. Controlling taxes has a direct correlation to making sure that the money lasts longer, as taxes tend to be one of the larger expenses throughout retirees' lives. Okay, so for example, let's say you need $50,000 from your retirement accounts. If all of that came from a pre-tax 401k account, that would be taxed as ordinary income, so you would need way more than $50,000 to net $50,000 from a retirement account to account for the taxes. Now, if you need that same $50,000 but you're pulling from a Roth IRA, you would pay nothing in tax. If you're pulling it from a non-retirement account, like a brokerage account, maybe you pay capital gains taxes, which could be significantly less than ordinary income. So here's a few more ways, but not necessarily pertaining to just your retirement assets. Look for savings and discounts, low-cost memberships to retirement organizations. I mean, as a senior, you can score lots of discounts if you just simply ask. So use your age to your advantage, and that can help increase your purchasing power. You can also consider downsizing your home or where you live. Some of you may have a much bigger home than what you need at this point in your life, so downsizing to a smaller home can significantly reduce some of your living expenses. Some of you may have dead equity in your home that could really boost your lifestyle if that was liquid. Even if you've already paid off your mortgage, your maintenance and utility costs could be substantially lower with a smaller home. Also, your primary residence has certain tax exemptions to it, where if you sell your home, depending if you're married or single, you could avoid up to $500,000 in capital gains, or $250,000 if you're single. So knowing your spending habits and sticking to your withdrawals, once you know what your withdrawal amount is, whether that be through the 4% rule, the dynamic income strategy, or income floor strategy, you need to be able to stick with that amount. It's not going to matter if you're spending a couple of bucks at Starbucks or going out to dinner, but knowing how much you can spend is going to help you keep on track. If you need help or would like to go over your plan with a professional, take advantage of our free financial assessment.